What that does off the back of that is it actually unlocks a whole bunch of new products and services which weren't possible until now.
Welcome, Bankless Nation, to this Alpha Leak episode where we cover Voltz Protocol. Voltz is an interest rate swap AMM. It's got Uniswap v3 code in it, and it helps us arbitrage interest rates across DeFi. Inside of one side of the Voltz protocol can go in variable interest rates, and out on the other side comes out stable interest rates. And Voltz is really a market maker, a coordinator between these two types of market actors in DeFi. Some people are willing to take the risk of volatile interest rates, and some people are willing to pay for that risk being reduced and get stable interest rates. And Voltz is an AMM that allows these two market participants to come together and meet in the middle, and allows one person to get stable interest rates and one person to get variable interest rates and perhaps a bunch more yield. There's also the conversation of liquidity providing, since this is using Uniswap v3 code, but instead of with assets, with interest rates, there's of course the possibility of being a liquidity provider and gaining a ton of yield. And Voltz really is trying to position itself as like the curve of DeFi for interest rates, where curve is where you go. It's the epicenter of stablecoin liquidity or like-kind asset liquidity. Voltz is going to be, or trying to position itself to be, the epicenter of interest rates liquidity in DeFi. And we don't really have a single central point of interest rate liquidity. While the interest rate swap market in TradFi is like $1 quadrillion, and I didn't just make that up. There is literally a queue. This is a line from Simon in the show. There's literally a queue in front of the volume in yearly interest rate swap market volume in TradFi. And if there's one thing that we know that DeFi produces, it's yield. DeFi is really good at producing yield, and AAVE produces some yield for some assets. Compound produces some yield from some other assets. We have the ETH stake rate. We have the USDC lending rate. We got the Yearn yield rate. We have all of these yield rates that are different from each other. And Voltz can be a coupler, a center point of liquidity between all of these different yield rates, allowing people to arbitrage them in a leveraged fashion, because that's what Uniswap v3 with concentrated liquidity does. The reason why I'm so bullish on Voltz is that it allows DeFi to set the interest rate dynamics of the Ethereum economy, right? The interest rates of crypto are set by the market rather than the Fed, right? And so in the TradFi world, interest rates are set by like 12 dudes in a closed room. There's no input. It's just like, it's whatever they say. Under like a Voltz paradigm, or really and this is why I really am bullish on the future of Voltz, is that Voltz allows the market to determine the interest rate. And so just kind of like how Uniswap v3 is an oracle for prices organically, like you put in DAI into one pool, Ether into one pool, and the market balances these things out and naturally prices DAI versus ETH. Voltz can naturally price the interest rates of all of DeFi. And so, this is bullish for just a bankless, permissionless money and finance system where we don't have 12 dudes in a closed room determining the cost of money. Instead, we have a protocol determine the cost of money, and that protocol could be Voltz. At least that is the bull case for Voltz. Of course, I ask Simon, is there a token coming? What about the token? When token? That question comes at some point during the show, so you'll have to stick around to hear about that. Just as a disclaimer, both Ryan and I have invested in as angel investors in Voltz in previous rounds, so we are access to the upside there. So that's the disclaimer there. So I want to get right into the show with Simon right after we talk about some of these fantastic sponsors that make the show possible. Rocket Pool is your friendly, decentralized Ethereum staking protocol. You can stake your ETH with Rocket Pool and get our ETH in return, allowing you to stake your ETH and use it in DeFi at the same time. You can get 4% on your ETH by staking it with Rocket Pool, but you can get even more by running a node. Rocket Pool is the only staking provider that allows anyone to permissionlessly join their network of validating nodes. Running a Rocket Pool node is easier to set up than running a solo node, and you only need 16 ETH to get started. Why would you do this? You get an extra 15% staking commission on the pooled ETH, so your APY is boosted. So if you're bullish ETH staking, you can increase your APY and get some extra tokens by adding your node to the decentralized Rocket Pool network, which currently has over 1,000 independent validators. It's yield farming, but with Ethereum nodes. You can get started at rocketpool.net and also join the Rocket Pool community in their Discord. You can find me hanging out there sometimes in the chat, so I'll see you there. The Layer 2 era is upon us. Ethereum's Layer 2 ecosystem is growing every day, and we need bridges to be fast and efficient in order to live a Layer 2 life. Across is the fastest, cheapest, and most secure cross-chain bridge. With Across, you don't have to worry about the long wait times or high fees to get your assets to the chain of your choice. Assets are bridged and available for use almost instantaneously. Across bridges are powered by UMA's optimistic oracle to securely transfer tokens from Layer 2 back to Ethereum. A token proposal is being deliberated as we speak in the Across forum, where community members will decide on the token distribution. You can have your part of Across's story by joining the Discord and becoming a co-founder and helping to design the fair launch of Across. If you want to bridge your assets quickly and securely, go to across.to to bridge your assets between Ethereum, Optimism, Arbitrum, or Boba networks. Arbitrum is an Ethereum Layer 2 scaling solution that's going to completely change how we use DeFi and NFTs. Over 300 projects have already deployed to Arbitrum, and the DeFi and NFT ecosystems are growing rapidly. Some of the coolest and newest NFT collections have chosen Arbitrum as their home, all the while DeFi protocols continue to see increased usage and liquidity. Using Arbitrum has never been easier, especially with the ability to deposit directly into Arbitrum through all the exchanges, including Binance, FTX, Huobi, and Crypto.com. Once inside, you'll notice Arbitrum increases Ethereum speed by orders of magnitude for a fraction of the cost of the average gas fee. If you're a developer who wants low gas fees and instant transactions for your users, visit arbitrum.io/developer to start building your dApp on Arbitrum. If you're a degen, many of your favorite dApps on Ethereum are already on Arbitrum, with many moving over every day. Go to bridge.arbitrum.io now to start bridging over your ETH and other tokens in order to experience DeFi and NFTs in the way it was always meant to be: fast, cheap, secure, and friction-free. Welcome, Bankless Nation, to this episode of Alpha Leak. On today's episode, I'm talking to Simon Jones, co-founder and CEO of the Voltz Protocol. And Voltz recently just went to mainnet. So Simon, congratulations on that.
No, thanks. It's super exciting.
Simon, for the listeners that haven't heard of Voltz Protocol or what that is, can you just explain the high level, explain like I'm five, what is the early explanation for Voltz Protocol?
Yeah, sure. So the really high level is that we have built out a protocol that effectively brings interest rate swaps to DeFi. And I guess to talk to the significance of that first. So if you just look at traditional finance as an example, interest rate swaps, they're just a core pillar to a well-functioning financial system. And to put that in context, there is a kind of almost cartoonishly large quadrillion of notional exchange each year in TradFi interest rate swaps. I mean, it literally starts with a Q. And it's that large because it supports such a wide spectrum of use cases, both across risk management, across speculation, but then also across the construction of a whole bunch of different products, both for corporates and for retail. And at the moment in DeFi, we don't have this piece of infrastructure. And what that does is it kind of, through it not existing, is it limits the amount of products that we can actually build in order for DeFi to be able to become the financial system for the whole of the world. So by us bringing this to DeFi, that is what we ultimately really hope starts to happen.
So let's keep things really basic here. What is an interest rate swap market? What is that?
Yeah, so there's basically a number of different actors that exist on the protocol. So we have LPs because it's an AMM, but just to ignore that for a second and talk about the traders, you are either what we describe as a fixed taker, where you are selling a variable rate of return in exchange for a fixed rate, or you're what we describe as a variable taker, where you are selling a fixed rate of return in exchange for a variable rate. And if I just talk about two kind of really simple use cases for that, so if you're a fixed taker and you have an asset that produces a variable rate of return, like CDI, for example, and you don't want that variable rate, what you can do with Voltz Protocol is you can deposit CDI as margin, which effectively enables you to sell a variable rate into the protocol. And in return, you are then converting that into a fixed rate asset. So you are selling variable and exchanging that for a fixed rate. Which, if we just look at that very simple use case, like an interest rate swap market actually opens up a very wide spectrum of use cases. But if we just look at that really simple one, what's really interesting is for the first time in DeFi, that has actually removed the silos between fixed and variable rates. You have a variable rate asset with a click, you convert it into a fixed rate asset. If we look at the other side and again take a really simple use case, so in this instance, you're a variable taker, you are selling fixed in exchange for variable. The fixed rate of return that you're selling away, if you're essentially wanting to go long the variable rate, so for example, if you believe there's another bull market kind of around the corner and the rates on CDI are going to increase, you can actually get levered exposure to that variable rate as it increases over time.
So the idea here is that there are some market participants that desire a fixed rate, and they will pay some amount of cost in order to access that risk-reduced rate. And so if you like lock in 4%, you have removed a lot of risk because you've removed the volatility of the fluctuations of the interest rate. And then there are people who are willing to be paid for taking that risk, who are willing to take the variable rates because being paid to take the variable rates comes with a higher yield, although you just don't know what that yield is because it's variable, but you also don't really care because you're willing to take the variance and the risk and collect what is like not a direct payment of a fee, but just a backdoor fee in the sense that you get to charge higher interest rates if you are the one taking the risk of the variance, and you are charging people who are de-risking what the yield is by getting a fixed fee. Am I on track here?
Yeah, kind of vaguely. I mean, there's a bunch of different actors that will exist on the protocol, but at its highest level, there are people who are more risk averse and therefore they are willing to sell away variable rate in exchange for fixed. And there's people who are kind of on that use case more kind of risk loving, who are basically able to take advantage of the fact that there are these more risk averse actors in the market.
Keeping things, again, high level, can we talk about why this market is so big in TradFi? Like a quadrillion, people don't know how to think about the word quadrillion. That's a very large number. Why is it so big in the traditional markets?
Yeah, it's really big because it supports such a wide spectrum of use cases, which exists across kind of three main buckets. So there's risk management, there's speculation, and then there's also the construction of a whole bunch of different products, both for corporates and for retail. And actually, in traditional finance, right, like, so if you were to go to your normal person on the street and say, hey, have you heard of an interest rate swap? Chances are they probably said no. But if you go to them and say, have you heard of a fixed rate mortgage? The chances are they'll probably say yes. And what's actually happening is in the background that in traditional finance, that bank which is constructing, or typically that bank which is constructing that mortgage for a consumer, they're actually using super low level capital markets infrastructure, i.e. an interest rate swap, in order to package up that product. So when we kind of think about this in the context of DeFi, if we want these types of products to exist, and if we want to increase like this spectrum of kind of utility that DeFi can provide to people around the world, such that DeFi can become the globe's financial system, right? We need this core pillar to exist such that we can start building these products and services.
Can you illustrate what DeFi looks before and after a like sophisticated, robust interest rate swaps market? Like what is the current state of DeFi? And then what is DeFi going to be once we have all of this infrastructure around interest rate swaps built out? What changes?
Yeah, so there's actually, if we look at DeFi today, there's almost a structural problem where DeFi is structurally variable. And this exists all the way across the stack. So if you go right to the bottom of the stack, to your kind of proof of stake mechanic, which is obviously where kind of vast majority of chains are converging, on a block by block basis, due to supply and demand dynamics, the rates of emissions which miners are able to generate change, right? So you have right at the lowest level, you have variable rates of return coming out of the ecosystem. On top of that, you've got protocols. So if you think of, say, AAVE and Compound just as examples, again, supply demand dynamics mean that the rates of return change on a block by block basis. And then on top of that, if you're a trading firm or you're trying to build products or kind of that you distribute to retail or whatever, even if you deploy some sort of market neutral strategy, you are doing that on top of an ecosystem that's structurally variable. And what interest rate swaps unlock at the most macro level is it enables us to build a system where we have structural stability for those that want it. And that it kind of opens up this whole spectrum of different use cases and products and services that can be built, which kind of span across different retail use cases. So that could be stuff which is on one end of the kind of complexity spectrum, stuff that's relatively simple, like fixed rate vaults, all the way through to actually at the other end of the spectrum, you could start building, for example, fixed rate mortgages on chain. And there are teams that have reached out to us since we've gone live, kind of exploring that as an idea. And then on the corporate side, you actually have stuff where you can do stuff around risk management, and you can also do stuff around speculation. So if we talk to risk management as an example, you may have a CFI lending business, for example, which is kind of promising, say, fixed rates of return on one side, but then kind of lending out variable rates on the other. And actually what they have at a balance sheet level, when you aggregate that up, is they have a rate liability, and they have no way of hedging that risk on chain. And all of a sudden with Voltz, you can do that, which enables them to be more stable as an entity, and therefore start to expand the products and services that they can offer. And then on the speculation side, what's actually really interesting is you can build, because it's a derivative and you can trade rates just like you can speculate with kind of like crypto assets, you can actually build a whole bunch of really interesting trading strategies that take advantage of kind of different rate markets and the way in which those rates are produced, and the fact that they kind of at times, for example, may diverge and you believe they're going to converge. And because you can do that and trade that exposure on Voltz with leverage, all of a sudden it's 100 basis points, which is 1% kind of like change. Actually, if you're doing that with 100x leverage, it becomes really attractive. So there's a much wider spectrum of use cases which then get opened up off the back of it.
And crypto has this branding of being this like chaotic, volatile, unstable Wild West. And perhaps it's because we don't have some infrastructure like this, which really creates like solid foundations for people to make like longer term plans. And so if some like big institution with a bunch of capital comes in, they need solutions to lock in their interest rates so that they can think in the long term, right? And like, you know, my model for this is that the crypto industry starts extremely degenerate, extremely speculative, extremely unstable, extremely volatile. But as it grows and grows and grows, both in just like amount of capital, a number of users, but then also like sophistication of financial primitives, all of a sudden we come up with tools to turn what is a chaotic, unstable place into a orderly markets with solid foundations. And like the cool thing that I'm seeing here with this is that you have two parties, one that is the volatile party and one that is the non-volatile, the stable party. And like the stability can come on the backs of degenerates, right? Like people that are trading with like 1,000x leverage on interest rate variance, and if they are right, they get a bunch of money. And the people that are looking for the orderly institutions can ride off of the liquidity of like the degens who are taking a bunch of leverage with interest rates. How do you like that take? Is that a good take, or what would you change?
No, I think there's definitely parts of that which I like completely agree with. I mean, it's completely fine for elements of like I have absolutely no issue. I think it's amazing that there's parts of DeFi that are kind of volatile. It's like lots of speculation. It's a completely legitimate thing to do with your money. But there's also, if we really want DeFi to become the financial system for the whole of the world, there's also a whole bunch of other people who don't want that. And actually, the existence of an interest rate swap market enables DeFi to exist for both sides of the market, and actually frankly enables those different types of kind of actors with different risk appetites to almost be able to kind of play off the fact that there are different people with different risk appetites, and you can effectively exchange that difference in risk appetite with one another.
Yeah, right. This Voltz seems like it can be a coordination tool between the risky and the risk averse, right? It allows the risk averse to find their other half to balance each other out to create a stable foundation.
In many ways, yes. And then what that does off the back of that is it actually unlocks a whole bunch of new products and services which weren't possible until now.
So a question about how Voltz actually works under the hood. Like we already have like stable interest rate options. Like AAVE has stable interest rates in its protocol. When you borrow like USDC or DAI or anything really, I think you can get a variable interest rate and pay a lower fee than what is offered for a stable interest rate. So like either you can lock in like a 3% USDC borrow fee, or you can get a variable interest rate, which will be something like 2.5% or 2%, but then there's the chance that that variable interest rate goes up to like 5% or perhaps even down to 1%. Like, but we already have this option in AAVE and in Notional as well. And so like other DeFi applications already provide this service. So what's different about Voltz?
Yeah, I think the key thing is that Voltz is generalizable and composable such that you can build a whole bunch of different products and services off the back of it. And alongside that, the other thing which is extremely different is that it's so capital efficient. So actually, when I kind of go back to when Artur's my co-founder, when he and I were going through a process of just figuring out how on earth you build this type of market in DeFi, where the constraints are frankly just fundamentally different to say traditional finance. If you're trying to look at that as an example, the kind of two things that we're really optimizing for was number one, capital efficiency, which has kind of led to a bunch of architectural decisions that we made in the protocol. And I guess the headline there is it is around 3,000 times more capital efficient than alternative structures. But then the other that we're really solving for is to try and make the protocol as composable as possible, which meant that we figured out a mechanic where everything exists on chain, such that people can start using Voltz as a very low level building block to build all these products and services that kind of we feel that it is going to unlock through the next few years.
Right. So AAVE and its variable or fixed interest rates is like a money market, but it only goes so far in providing like the actual tooling for all yield bearing assets to be able to access both fixed and variable interest rates markets. But then also like another big difference is that with leverage, right? And so you can only arbitrage the differences between variable and fixed interest rate markets on AAVE it only goes so far because of like the capital intensivity, and AAVE is just not really meant for that. Voltz is specifically meant for arbitraging the differences between variable and fixed interest rates, and you are able to do it with leverage. How does the leverage happen? How do we get like leverage interest rate market swaps? Like where does that key unlock come from?
Yeah, so the way that we've built the protocol is we deliberately split out the AMM from what we describe as the margin engine. And the AMM, what that now does is we describe it as a virtual AMM because it essentially only acts as a pricing oracle where we essentially mint and burn fixed and variable tokens as trading activity takes place, and that obviously drives the price. That then acts as a pricing oracle into the margin engine. And the margin engine, we often describe it as the beating heart of the protocol because it's responsible for defining the leverage that you can take as a trader. It deals with settlements, it deals with liquidation events, it collects fees for LPs. It basically does everything except the pricing oracle, which the virtual AMM does. And then in terms of like specifically how it creates leverage, so if I just walk through kind of a really simple use case, if you've got a pool which has got a 1-year term, and say you're a variable taker, so you're selling a fixed rate, and imagine the price of the fixed is 10%, right? If I'm doing 100 of notional, a really simple kind of model would assume that I need to deposit 10 of margin, right? So I've got 100, 10% for a year, 10 of margin. And so in that instance, you are already trading with 10x leverage. But what's actually very naive about that model is it would assume that the variable rate would just drop to zero and stay at zero through the entire course of the term, which actually when you start to run a whole bunch of modeling around that, it's just extremely unlikely to happen. So what we have instead is we have a margin engine which computes predictions into the future of what your likely upper and lower bounds are going to be for a rate. And then that defines, kind of within a safety measure, it defines the amount of leverage that you can take as a trader, which actually in some instances, particularly as rates actually start to come down. So if you go from 10 to 1%, you could theoretically be fully covered and only be depositing 1 instead of 10 for a year term. As rates start to come down, it means that actually you're able to take more leverage as a user. So the actual kind of underlying number associated with the rate is not what matters because it's offset by the fact that you're able to take more leverage.
And this is where, we're definitely taking a peek under the complexities of the Voltz protocol and what really powers the Voltz protocol to make it different than all the other fixed versus variable interest rates markets. Can we actually just zoom out and like start from the very beginning about the technical details behind Voltz? You talked about how it's a virtual AMM, and like I kind of can wrap my head around that. But like, can we just like go and do just a walkthrough of like all the details of the Voltz protocol under the hood? I know you already just did it, but like let's start from the beginning and like go through it like step by step.
To explain the architecture, it's actually easier to just explain the different actors first. So we've got 3 different actors. You've got liquidity providers, you've got fixed takers, and you've got variable takers. If you are providing liquidity, we actually borrowed concepts from Uniswap v3, where we have tick kind of spacing within the AMM. So as a liquidity provider, you choose your tick range that you want to deposit liquidity within, and that's essentially the way which you go about doing it. But that requires you via the margin engine to...
And that's like in Uniswap v3, that's like concentrated liquidity. Right? That's the concept of concentrated liquidity in V3. When you say like providing between two tick ranges, this is the same thing, but with interest rates rather than asset pricing, right?
Exactly. And actually, if anything, what's really interesting is, well, not only does that unlock capital efficiency, but actually within a rates market where your rates tend to be mean reversing, if anything, it's actually a better use case for the concentrated liquidity mechanic. Which I guess to talk to that just very briefly. So if you've got DAI and ETH, for example, where that's quite volatile, as a liquidity provider, you are having to change your tick ranges relatively regularly. In a rates market where rates have this mean or exhibit this mean reversing behavior, actually you can choose your tick range, and even if the rates kind of go out for a period of time, you can kind of like confidently kind of predict that it's going to come back. At which point you might not even need to change your tick range. You can just leave your liquidity there for a period of time.
Right, yeah, and just to double down on that, providing liquidity between Ether and DAI, some people choose to do this behavior, but I don't choose to do this behavior because I think Ether is going to like $10,000 and beyond.
Yeah.
And so like I don't want to be providing liquidity there when I want and bet on Ether going up and up and up and up. That same bet doesn't happen with interest rates, right? Like it's just ridiculous to like make a bet that you think the interest rates are going to go from 5% to 10% to 20% to 100% to 1,500%. That's not how interest rates work. They never really get that far away from some certain mean. And so liquidity providing inside of a concentrated liquidity model that Uniswap v3 unlocked is like more efficient from like a fee taking perspective, because when it mean reverts, what that means is that it's going back inside of a range that you can depend on more than like Ether. Ether's not going back into a range, like Ether's going to the moon. So it is meant to escape the ranges. But interest rates are meant to stay inside of certain like ranges, and so I just wanted to like double down on that explanation there.
Yeah, no, that's absolutely. I think the only thing which I'd add to that is obviously in bull and bear markets, in a real bull market, you see that the underlying rates on say AAVE and compound do typically go up, so you kind of end up at this more a different equilibrium, but they still tend to exhibit mean reversing behavior around some sort of equilibrium.
Mm-hmm. Right. Like we're not seeing 10 or 100 X's in interest rates. And not for very long, at the very least.
Not for
okay. So we just explained concentrated liquidity providing with interest rates. Where does the protocol process go from here?
Yeah, so you've got the three actors. You've got liquidity providers, which obviously provide liquidity through that mechanic, and then you've got your fixed and variable takers. It's really important to think about that architecture of your virtual AMM and your margin engine, because every single actor, including liquidity providers, you are depositing margin to cover a position, and then that is minting fixed and variable tokens, which is your actual notional that you're trading, and that's going into the AMM. And your notional that you're trading is essentially your margin times your leverage. And by separating these two out, not only does it enable us to essentially have the ability to introduce leverage into the rates market, but it also enables us to have this mechanic where the virtual AMM is just purely functioning as a pricing oracle.
From the user perspective, from the external perspective, Voltz is Uniswap v3 for interest rates, but it doesn't mimic Uniswap v3 in every single way, in the sense that you aren't not depositing assets. It's using the Uniswap v3 code as an oracle more than it is an actual exchange. Is this correct?
Yeah, so we originally, when we actually kind of came up with the idea, we thought that we could route trades via Uniswap v3, and then actually when you start going in and kind of really trying to build that, actually there's so much of that code that basically needs completely refactored for a different market, that in the end we actually needed that code to be native to our code base. And it is essentially only the very low level kind of building blocks, such as the use of tick ranges, that actually ended up going into our code. I don't know if you remember this, we actually had to go through, obviously Uniswap v3 code is subject to what's described as a business source license. So you can't just fork it and kind of put it into your code base. So instead we had to go through a process with the Uniswap DAO where we asked the Uniswap DAO to provide us with essentially a license. It's actually described as an additional use grant, but it's a license which allows us to have Uniswap v3 code in Voltz Protocol code base.
Yeah, this is a fun piece of DeFi trivia. Uniswap v3, rather than being fully open source, it's licensed for a number of years. I think something like 3 to 5 years or something.
Yeah.
And that's just mainly to protect the efforts of the Uniswap team and the investors. Eventually, it will that time frame of licensing will definitely just end, and it will become open source. I can't remember the years on that. It's like 3 to 5 or something. But Voltz Protocol wanted to use Uniswap v3 code inside of its application, and so it needed to convince the Uniswap organization, the Uniswap DAO, to allow Voltz to use the code, because the code is licensed. And I think Voltz gave Uniswap 1.5% of all tokens in order to pay for this license. Is that the correct number?
1%. Yeah. But yeah, 1%, exactly. Yeah.
1%. Which is just a cool story of just like inter-DAO relationships. So like one org wants to pay another org to use their software, and so they just paid them 1% for the costs of producing Uniswap v3, and now it's integrated inside of Voltz, which is actually an interesting business model that I don't think many people think about Uniswap or even open source software that's not fully open sourced yet. But just like kind of a cool side quest of a story between Voltz and Uniswap v3.
Yeah, and what was really cool about that is the first ever like DAO-to-DAO deal that has taken place in this space. We actually expect, and we've already seen a bunch of proposals that kind of mimic that. So we expect that to continue. But what it also does is actually ties the success of the two DAOs together in many ways. So we've got people coming in from the Uniswap DAO that are now contributing in different ways to the Voltz kind of protocol and to the DAO that we're building out. And then alongside that, kind of going back to Uniswap, well, like they own 1% of Voltz's future token. So as Voltz grows, that actually has an economic advantage to Uniswap as well. So it's not, what's actually really nice there is it's not just the composability of the software. You start getting some sort of composability across the two communities as well, which is pretty nice.
Yeah, the phrase composable communities is something that Ryan and I have been like leaning into ever since DeFi summer. While it is like a 1% capital cost from the Voltz organization, from like all the 1% of the capital goes to Uniswap, it's also kind of investment in Uniswap and Uniswap's community. So it's not just like it's not just like a cost, it's not just like a negative on the balance sheet. You also get the Uniswap v3 code, but also Uniswap talent just by proxy because of how composable these ecosystems are.
Yeah, exactly. And what it means is that Uniswap, very much the grandfathers of AMM design and perhaps in version 4 or whatever, like assuming they kind of are working on that type of thing, there's opportunities for the ideas that are generated within that ecosystem to really kind of like come through into the Voltz community as well, because you have these people that now start to exist across the two ecosystems, which then just enables more innovation and kind of ideation to take place, which perhaps as an ecosystem gets us to an even better place as well.
The Brave browser is the user-first browser for the Web3 internet, with over 50 million monthly active users. Control your digital footprint with built-in privacy and ad blocking. Inside the Brave browser, you'll find the Brave Wallet, the first secure crypto wallet built natively inside of a Web3 crypto browser. Web3 is freedom from big tech and Wall Street, more control and better privacy. But there's a weak point in Web3, your crypto wallet. The Brave Wallet is different. Brave Wallet is built natively inside the Brave browser, no extension required, which gives the Brave Wallet an extra level of security versus other wallets. With the Brave Wallet, you can buy, store, send, and swap your crypto assets, and you can even manage your NFTs and connect to other wallets and DeFi apps, all from the security of the best privacy browser on the market. Whether you're new to crypto or a seasoned pro, it's time to switch to the Brave Wallet. Download Brave at brave.com/bankless and click the wallet icon to get started. AAVE is the leading decentralized liquidity protocol, and now AAVE v3 is here. AAVE v3 has powerful new features to enable you to get the most out of DeFi, including isolation mode, which allows for many more markets to be launched with more exotic collateral types, and also efficiency mode, which allows for higher loan-to-value ratios, and of course, portals, allowing users to port their AAVE position across all of the networks that AAVE operates on, like Polygon, Phantom, Avalanche, Arbitrum, Optimism, and Harmony. The beautiful thing about AAVE is that it's completely open source, decentralized, and governed by its community, enabling a truly bankless future for us all. To get your first crypto collateralized loan, get started at aave.com. That's AAVE.com. And also check out the AAVE Protocol governance forums to see what more than 100,000 DAO members are all raving about at governance.aave.com. MakerDAO is the OG DeFi protocol. The MakerDAO produces DAI, the industry's most battle-tested and resilient stablecoin. Using Maker, you don't need to sell your collateral if you need liquidity. Instead, you can spin up a Maker vault and use your collateral to mint DAI directly. With Maker, the power to mint new money is in your hands. The Maker protocol is extremely hardened and operated by one of the most experienced DAOs in existence. They've been here since the beginning, they've seen it all, and so you can mint DAI with the assurance that your collateral is safe. Soon, Maker will be present on all chains and L2s, so minting DAI can take place on Oasis.app, Zerion, Zapper, or any other DeFi protocol that you use. Follow Maker on Twitter @MakerDAO and learn from the oldest and most resilient DAO in existence. Yeah, so we were going through the details of the Voltz protocol under the hood, and we kept on finding these side quests. Can we do it like one more time where we just like speed run through the 3 market participants, the variable interest rate sellers, the variable interest rates buyers, and then the liquidity providers?
Yeah, sure. So, well, the way that it works is you have these 3 participants. Liquidity providers provide liquidity within tick ranges that creates the market from which fixed or variable takers can start trading. And the way that works at a kind of a more practical level, so imagine you've got a fixed taker who comes in, they're wanting to sell a variable rate in exchange for a fixed. What they can do in the way that works relative to the liquidity providers is if the kind of price is within the liquidity provider's tick range, fixed taker comes in, they initially use the liquidity provider's liquidity to execute a trade, at which point the LP is effectively the variable taker because they're on the other side. But then if a variable taker comes in and has the same amount of notional, the price is at the same point, and they do the trade, actually what happens, although they use the LP's liquidity initially, those 2 trades then actually net each other off, and the liquidity provider's kind of liquidity then kind of is released and goes back into the AMM to continue to collect fees. And that's a process that we describe as margin recycling. And then those 2 positions basically are sat as essentially, it's actually a pool-to-pool basis rather than peer-to-peer, but they're sat in 2 pools, which are supporting either side's position until the end of the term.
This kind of feels like a perpetual swap market as well, where like there's a central contract, and then like it just it orients the 2 sides of the market. But I guess that's all kind of how all markets work.
Yeah. So
with the margin recycling. Yeah. Sorry. Go ahead.
Well, I was going to say one of the key things is that all the pools on Voltz have terms. So the pools which are live at the moment, they have 60-day terms, and that means at the end of the term everybody settles. But the margin recycling, when we're thinking about coming back to some of the stuff that you were saying before about how like Voltz is different and how we kind of create this market, actually having fixed and variable rates which are tradable within the same AMM, such you can transition from one side to the other and back again. And what that does from a liquidity provider's perspective, where you're able to have this margin recycling mechanic, all of that contributes to having a kind of an AMM design that is ultimately more capital efficient and removes the silos between fixed and variable rates. It's all mathematically connected.
Why fixed at 60-day terms? Why is there a future where Voltz is like infinite terms, or like what's the story here?
Yeah, so rate markets are still relatively new in DeFi. So kind of opening up pool terms that had kind of a year term, and someone's trying to speculate on what's going to happen to the variable rate on CDI over the course of an entire year. It is, the cycles that exist are just a bit too unpredictable for someone to kind of reasonably take a view on what's going to happen over that longer period of time. So what we did instead actually is we built ourselves a whole bunch of statistical arbitrage kind of models internally. We've actually, within the Voltz Labs team, we have our own quant team. And we started looking at what type of kind of APYs can you generate depending on how long the pool terms are and that type of thing. And that's where we landed on actually a 60-day term to begin with, is a sensible length of time, which enables you to have a few cycles in rates where they kind of like converge, say between A die and C die. It will converge for a period of time, and then it will kind of come back to diverge and then converge, which means that you can start building these models that trade that kind of movement with leverage in a time period that is sufficiently long enough for that to take place, but also sufficiently short enough for people to be confident speculating over that period of time.
So is this 60-day window, what's the vision for the development of different time frames. And we're now getting into the conversation of the Voltz Roadmap, so we can talk about that next. But first, like, what's the roadmap for like opening up further longer timescales?
Yeah, so we can. It's very the protocol is generalizable actually to the point that not only can we introduce a market on top of any asset with a variable rate of return. So long as we have a rate oracle pulling in the variable rate, we can basically create an asset on top of any asset. A pool on top of any asset. So to begin with, we've done that on AAVE and Compound, and we've just done that for 60-day terms. But we will launch pools on top of kind of other assets, and one of the ones which we've been public talking about is Lido. Kind of in the future as well. And then in terms of the actual term, it's super straightforward. We kind of felt 60 days was the most sensible thing to start off with, but we could very easily introduce 90, 180 days, even a year-long term, if that's what the market desired. But the thing is, if you start stitching these 60-day terms onto each other, you can sort of replicate something similar anyway.
Yeah, so Voltz can open up any length of market that it wants to. It just needs to make sure that there's enough liquidity there. And so it sounds like the interest in specific timeframes is going to be what determines those timeframes like opening up. And so since Voltz is literally it's like it just got pushed to mainnet very, very recently, starting with 60 days, and then as Voltz gets adopted, the interest rates markets on DeFi grow, so will the options for timeframes inside of Voltz. Is this all tracking?
Exactly, and because if you were to have, say, a 60-day term on an ADI pool and a 90-day term on an ADI pool live at the same time, actually what you're doing is you're fragmenting liquidity across those two pools. So it's a lot more sensible actually to have kind of shorter duration single pools to begin with. And then as the liquidity starts to increase, we can start opening up kind of more terms kind of on the same asset.
We know that stablecoin yield is huge in DeFi, of course, but also we are coming up to the merge. So like this is a beautiful moment for Voltz to be on mainnet as Ether goes from proof of work to proof of stake. So I definitely want to talk about the future of Voltz with like the ETH stake rate and its relationship as like a financialization of ETH. Financialization layer on ETH. But first, I just want to get more of like the Voltz roadmap. What are you guys working on like right now? What are you guys working on the next few weeks, next few months, and then like longer term horizons for the next few years?
Yeah, so in terms of right now, we're obviously in this alpha state where we've just very recently gone onto mainnet. And what alpha means at a more practical level is there's a cap on the amount of liquidity that could be provided as an LP per pool. Which not only enables us to kind of like test it in a more safe environment to begin with, it then means as trading volume starts to pick up, we will start opening up those caps too. But then alongside that, we're actually working on a bunch of different rate oracles, which pulls in the underlying variable rate on chain. So the kind of first one, which we've been kind of obviously public and talking about, is that we're going to launch Lido markets, which will enable people to speculate on the rate of return that they expect to occur on staked ETH. And we'll launch that alongside a bunch of other ETH-based pools, so AETH, CETH, for example, which actually also enables people to start arbitraging between those different rates and the way in which the rates are behaving in different kind of protocol designs.
And there's so much coming online in DeFi right now. Like there's AAVE and Compound, of course. There's also Rari's Fuse pools, which can create interest rates. But then there's also Euler Finance, which is a brand new AMM, which can also tap into Voltz. So it sounds like any money market like AAVE or Compound or Euler or Fuse can just hook into Voltz. And it can take their variable interest rates and Voltz can turn it into stable interest rates. So this Voltz seems like a tool for every AMM or every money market that comes into DeFi. But then also, like we have Lido staked ETH and Rocket Pool's RETH. And we have these two variable interest rates, but also coming online is the new Coinbase announced one. Alluvial, I think, is also a new like liquid staking as a service organization. Obel Network is here to like make a bunch of competitive staking as a service networks, and so perhaps a bunch of liquid staking derivatives. There's also like things like StakeWise, and like all of these things that produce yield in DeFi. And I make this joke like Bankless listeners who tap in to Bankless all the time will hear me say this joke all the time. Like crypto is here and is made really three good things. Like there's three good things that come out of the crypto world. One is non-sovereign store of value money, and that's Bitcoin and Ether. The second one is yield. Like that's the second big thing that crypto makes. And then the third one is content, which is like the joke, but also I think it's true. But like Voltz, if you agree with me that like the first use case of crypto is money and the second use case of crypto is yield, well, Voltz is turning that whole entire second use case and making it stable and allowing other people to take the risk and the upside on the volatile side. And so as we get into the ETH post-merge state where Ether yield rates go from like 4.2 up to 7 and beyond, but then also goes up further as a function of the heat of the Ethereum economy. The hotter the Ethereum economy is, the more higher the ETH stake rate goes. I'm sure like Voltz is just like licking its lips at just like the possibilities here. So like how do you guys think about how Voltz interfaces with the ETH stake rate over the long term?
Yeah, well, I mean, you kind of touched on it there. Because the protocol is generalizable such that we can create kind of pools on top of any asset with a variable rate of return, all that's required is a rate oracle to be built for all of these different protocols, at which point you can start speculating kind of on the direction which kind of the rates of return on say, staked ETH is going to go over a period of time. But then you also can start arbitraging between different protocols. So what becomes really interesting is as you start getting kind of more competitors to Lido, if they are starting to produce different rates of return, you can start arbing that with leverage by the fact that Voltz exists, which is obviously something which you could not do before, which starts to be, obviously kind of post-merge, it starts to become kind of really interesting as the dynamic evolves and as there's more competitors which start to exist. Actually, people starting to speculate on that, we see as like a really interesting and big use case for the protocol.
I want to touch on the very last participant in the Voltz ecosystem before we talk about some candy topics. I am going to ask if there's a token. The liquidity providing. Why would somebody provide liquidity? What do they get out of it? And can you also explain the cool quirk about Voltz and liquidity providing, which is there is no impermanent loss because we're not trading across assets, but instead there's this other thing. Can you overall just like pitch why somebody might be interested to be a liquidity provider and like the whole like trade-offs that come with being a liquidity provider in Voltz?
Yeah, I mean, well, the headline is that there's opportunity to generate pretty significant APYs, which is both driven off the fact that you are depositing within tick ranges, so therefore your capital is more capital efficient. It's also driven off the fact that actually you are generating fees off your notional, but you're only having to deposit margin in order to create that notional within the AMM. And then the last thing is actually this kind of really interesting dynamic where, say, unlike a Uniswap V3 pool, where you have two assets, like say DAI and ETH, with a rates market, your kind of fixed takers and your variable takers are getting paid in the same kind of underlying asset. So if you've got a pool which is created on top of C DAI, your fixed interest rates are in DAI and your variable interest rates are also in DAI, which means as a liquidity provider, to actually create either side of the market, you only have to deposit one asset, which is DAI. And then all of a sudden, you do not have the concept of impermanent loss. It is replaced with other risks. So we have what we describe as funding rate risk, where just for argument's sake, imagine a fixed taker came in and traded with your liquidity, but a variable taker never came in and then did the opposite side of that trade. What would actually happen is your liquidity would be locked into that position, supporting the fixed taker until the end of the term. And you're more exposed to that risk if you are depositing within a tight tick range at a place where it kind of like your tick is outside of the band where you have this mean reversing behavior. So that's the small quirk, which is, I guess, is different to impermanent loss. But if you're depositing it within a tick range where you've got balanced trading activity taking place on either side, all that's happening is you support a trade until a corresponding trade nets it out. You go through this margin recycling process and you're collecting fees.
Okay, so if instead of impermanent loss, you're exposed to the risk where if there is a lopsided market, as in there are more people on the fixed side of things and not enough people to support those people on the variable side of things, that is the new impermanent loss for Voltz. I kind of didn't totally follow the mechanic on how it works, but that imbalance costs you yield, costs you fees, and like you are the one taking the weight of that imbalance as a liquidity provider in Voltz.
Yeah, that's right. There's a chance that costs you. So if you end up having a position that's not netted out, and if it happens to be, for example, a fixed taker position, and the underlying rate market moves against you, because on one side it's going to move for you and on the other it's going to move against you. So if you don't get netted out and the rates move against you, then there's a risk that you are supporting that person's position, that trader's position. But the best way to kind of avoid that is obviously to put your liquidity within a tick range where there is balanced trading activity, at which point you just have this continuously recycling mechanic.
So Simon, is there a Voltz token?
Well, so we did the Uniswap DAO to DAO deal, and they received 1% of Voltz's future tokens. So I think it's completely fine to acknowledge that there will be tokens in the future, but right now there is no Voltz token.
Okay, so there's just like there are ideas for future tokens. Do you know how that token would be released into the public?
So there's a lot of the design around that and the decisions around that, which honestly have just not been a core focus as we've been building the product and getting it live. Obviously, we want the whole kind of protocol to be transitioned to a DAO such that it becomes a public good, which is owned and managed by the community. I think it's incredibly important for the whole ecosystem. But exactly how that gets distributed is obviously not decided at this stage.
What are the parameters that if you had a token, the token would likely govern over? Like what are the governing parameters of the Voltz protocol? Yeah,
so there's the initiation of new pools. There's kind of launching of new markets. So say if you wanted to launch a pool on AAVE instead of Compound, but then there's also the actual risk parameterization and the setting of things like LP fees, which are all things which can be voted on via governance.
I'm assuming since like we've been talking about Uniswap v3, there's probably also like the concept of a fee switch, whether that's like formally built into the protocol from day one or introduced later, but there would be like perhaps like a fee switch mechanism that is similar to Uniswap's fee switch mechanism as well.
Exactly. So the way that the protocol can generate fees for the treasury so LPs generate fees, and the protocol can collect a proportion of LP fees if it chooses to. That is currently set to 0, but obviously it is a governance decision for the future as to whether to switch that on or not.
Okay, awesome. Simon, this has been really, really interesting. I've learned a ton. Are you guys hiring? What kind of jobs are you guys looking for? Or like for people that just want to like join the community, what kind of people are you looking for? Or just like overall, what talent are you looking to find in the Voltz ecosystem?
Yeah, so we've been growing pretty aggressively over the beginning of this year. If I go back to January, it was literally just Arthur and I, Arthur being my co-founder. We're now a team of 12, going to be 14 relatively soon. We're obviously always on the lookout for kind of really high quality kind of developer talent. We're also looking for a head of growth. But then actually within the community itself, because we're kind of such a low level building block, which unlocks so many new products that could be built in this space, and we're constantly getting teams coming through who have, now that we have this new market, which is an interest rate swap market, constantly getting teams coming through, thinking of new products that can be built on top of that, which spans from stuff across like swaptions through to more simple products like fixed rate Voltz, even using kind of Voltz as a form of stable coin collateralization, which is a pretty interesting use case. We've got 2 teams which are doing that at the moment. So if there are teams which I guess ultimately are listening to this and thinking, oh wow, there's this new market that's being created and actually unlocks all of these kind of new opportunities for me as a builder, come into the Discord. We often set up kind of like one-on-one channels with that team and the Voltz Labs team, and we really try and help teams through that ideation process to the point which they can actually go live.
Amazing. Well, Simon, we will get the link to the Discord, the Twitter, and all the other relevant information into the show notes for listeners that want to dive deeper into the Voltz rabbit hole. Simon, any last comments or anything you want to share that I forgot to ask about before we sign off here?
I don't think so. I think that the main thing which I'd say is that when we're going through a process of kind of figuring out what we felt was the next 0 to 1 innovation required to move the whole sector forwards, interest rate swaps, they're just a core pillar to any well-functioning financial system. So by us building this, we want it to help DeFi ultimately become the financial system for the whole of the world. And in order for that to happen, we need, now that this low-level piece of infrastructure needs to exist, that kind of provides these opportunities for people to start building these new products and services which serve a much wider spectrum of financial needs. And that's frankly, that's the one thing which, more than anything, that's the thing which kind of excites us about the fact that we've now launched.
Amazing. Yes. And once again, congratulations on getting to mainnet. This is, well, I'm sure it also feels like the end of a very long journey. It is also just the start of an even longer one. So wish the best to you and Voltz. And thank you for coming on and sharing all of this alpha in this Alpha Leak episode with the Bankless Nation, Simon.
No, it's been awesome to be here, and I kind of really enjoyed talking to you.
Bankless Nation, of course, disclaimers. ETH is risky, crypto is risky, DeFi is risky, trading interest rates is also going to be risky. You can lose what you put in, but we are headed west. We're on the frontier. It's not for everyone, but we are glad you are with us on the Bankless journey. Thanks a lot. Hey, we hope you enjoyed the video. If you did, head over to Bankless HQ right now to develop your crypto investing skills and learn how to free yourself from banks and gain your financial independence. We recommend joining our daily newsletter, podcast, and community as a Bankless Premium subscriber to get the most out of your Bankless experience. You'll get access to our market analysis, our alpha leaks, and exclusive content, and even the Bankless token for airdrops, raffles, and unlocks. If you're interested in crypto, the Bankless community is where you want to be. Click the link in the description to become a Bankless Premium subscriber today. Also, don't forget to subscribe to the channel for in-depth interviews with industry leaders, Ask Me Anythings, and weekly roll-ups where we summarize the week in crypto and other fantastic content. Thanks everyone for watching and being on the journey as we build out the Bankless Nation.